Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, March 4th, 2022. And our top story today, commercial real estate is expected to bounce back in 2022. Well, joining me now to discuss this and a lot more, Deidre Woolard is a real estate expert with The Motley Fool. Deidre, it's always great to see you. Thanks so much for joining us on the program this morning.
Thank you for having me.
All right, let's talk commercial real estate, and we're going to talk about it from a couple different perspectives. The first is, let's talk about it's projected to really bounce back in 2022. We'll get to the sanctions in a little bit, but just general perception around the return to the office and what it means for commercial real estate.
Well, what we're seeing is a partial return to the office. So Google announced yesterday that by April 4th, they're going to have people come in 3 days a week. Wells Fargo has talked about 2 days a week. So we're seeing these big companies make these partial moves and really trying to give the employees a bit of what they want, but also give the employers what they want, which is people back in the office. And we had the president talking about getting people back into the office in the State of the Union. So it's clear that there's a big move to get people back into the office. I think the employees are a little less thrilled about that, and that's why you're seeing these sort of hybrid situations develop.
Well, I mean, I totally get it. And there are some, look, I think the argument is there are some lessons learned from remote working. There are some positives of working in the office. There's positives of working remote. Maybe sanity is one area, but also sanity, leaving your family at home. I've been home with 2 cats for a long time. I'd be a lot more sane in the office personally, and my wife would be very happy. Deidre, what does it mean? Let's look at the hospitality industry as an example. Hotels, the service industry faced a lot of headwinds. It seems like that could bounce back for the first time in 2 years.
Yes, but certainly not as much on the international side due to the conflict in Ukraine. I think that is making people a little less certain about traveling abroad. But we are seeing some strong rebounding in hospitality in the U.S. Latest numbers from STR, which tracks this sort of thing, had occupancy at around 60%, which is still about 8.4% down from 2019. But we're definitely getting back above that 50% level. And that's really good news for hospitality. Airbnb also had really strong earnings. They're seeing a lot of travel. Part of this remote work and hybrid work thing means that people may be doing a lot of 3-day weekends and things like that. Because if you only have to be in the office for 2 or 3 days, maybe you take those other days and work remotely somewhere else.
Yeah, I was talking to Andrew Gross from AAA last week. They're projecting travel to really pick up. I guess people are kind of fed up with the mess. They want to get out on the road. They're willing to take some more risks. So hopefully that helps feed the hospitality industry. Deidre, what if you're invested in REITs? A lot of real estate investors, average folks like myself and institutional investors, invest in both direct real estate and real estate investment trusts. Are those going to have a bounce back as well? Or could those have a bounce back? I won't put you on the spot.
Well, REITs had a tremendous year last year, up 40% from the year before. The REITs have not had a good year this year. They're being dragged down along with the rest of the market, not to the extent that we're seeing with some tech stocks, but REITs are still getting hit right now, which is not necessarily in tune with the earnings. Earnings for REITs have been strong. We're seeing a lot of good numbers around rents and leasing in the retail spaces. So the numbers are strong, but the stock numbers aren't necessarily reflecting that right now.
Deidre, you mentioned at the top of the segment, we talked a little bit about sanctions. Let's talk about these sanctions and what it could mean for the commercial real estate industry. Obvious, I think, to everyone is that if you are an international company and you have offices in Russia or thinking about offices in Russia, that could be a significant challenge. But does it mean anything to domestic real estate here in the U.S., I mean.
The one thing it may mean is that the government is taking a closer look at the real estate that the oligarchs own in the U.S. This isn't necessarily a new thing. The government has the Financial Crimes Enforcement Network. They've had rules for a couple of years that require title insurance companies to identify people behind shell companies to prevent things like money laundering. So there's already been looking into who owns what. A lot of it is so hard to track, but I do believe there will be increased focus on Russian-owned real estate, and there may also be some impact to New York City and Miami, which are two areas where you have a lot of Russian investment.
Yeah, well, I personally like Miami. Beautiful, and it's beautiful this time of year. Last question. I mean, we've seen maybe pre-pandemic a lot of foreign investment, forgetting Russian investment, but a lot Saudi. A lot of international other companies coming into the U.S. That abated during the pandemic. Might it pick up now that things are kind of loosening up, opening back up? And even if the Russian sanctions on Russia have an impact, there's probably another buyer out there who's willing to pick up some real estate here in the States.
I would say that the stability of the U.S. market, the stability of the U.S. dollar is something that has always been attractive to foreign buyers. We've seen a lot less investment from China over the last couple of years, even pre-pandemic, due to some changes over there and the ease of getting money out. But there are always various countries that are going to be interested in investing in U.S. real estate because of the stability and because it is such a great place to put your money and see returns over time.
Yeah, I feel like we got a lot of space here. We only have 330 million people, give or take. I didn't count recently, but we have this huge area and we're constantly developing. I feel like this is a great place to invest, whether you're here in the States or internationally. Deidre, I need to take a quick break. When we come back, we'll switch gears. We'll go from commercial real estate to residential real estate, and home prices are looking like they're going to be double-digit gains in 2022. You're going to find out more if you stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. We're talking this morning to Deidre Willard. She is a real estate expert, if I do say so, with The Motley Fool, and I think a lot of people agree, and not just me. Deidre, thanks so much for sticking with us this morning.
Thank you. I'm excited to talk residential.
Yeah, let's talk residential. We had some fun talking about commercial. A lot of good insight there if you're thinking about buying REITs, direct real estate, et cetera. If you're on the institutional or individual side, let's talk about if you're thinking about buying a home. The real estate market was already complicated, as it was, because there are fewer homes, Deidre, to buy, less inventory. Now we've got interest rate hikes. What's your assessment on home prices and what that may mean if you're a first-time or a continuing buyer?
We're expecting to see a little bit less of an uptick in real estate prices in 2022, which will be a relief because last year we had double-digit gains. May get double-digit gains again this year. Part of it is just this inventory problem. I feel like every time I talk to you about the inventory problem. It's not going away. And some numbers from Redfin that came out recently, people are staying in their homes an average of 13.2 years. That is a really long time. And so part of that is because prices are so high, people can't move up. And it takes people so long to get into a house. Some of it is schools. But that fact that people don't move around has just led to low inventory. We're building homes, but we're not building nearly enough. We're dealing with prices of lumber and steel that are contributing to costs. There's just a lot of pressure on the housing market.
Yeah, I think the inventory is expected to go up 1%, if I'm not mistaken, if I looked at the numbers correctly. Still a large number of homes, but 1% is not a huge amount at all. And again, you mentioned the supply chain, the construction materials, the workers. There's a lot of headwinds. What about rents? Rents have gone through the roof now. I mean, you go to some of these big metropolises, New York, San Francisco, here in Charlotte, rents are going straight up too.
Rents went down for just a little bit during the pandemic, and then they soared back up so quickly. So that is definitely a concern. We're seeing a lot of kind of rents going up, especially in the Sunbelt areas. All of those places where people migrated to during the pandemic, rents went back up. So there's a lot of pressure there too. It is still mostly more economically sound to buy instead of rent in those markets, but it's changing. Another factor you've got is the iBuyers. iBuyers bought 70,000 homes last year, the most ever. So you've got this other force that is also taking homes off the market, and a lot of the homes that they buy don't go back into the general pool when they get refurbished. They go sold directly to single family rentals. So there are massive portfolios of single family rentals being amassed, and that gives those companies a lot of pricing power. So that's another concern for consumers.
Deidre, I can't let you go talking about residential real estate without talking about mortgage rates. And before this crisis in the Ukraine, we were already seeing mortgage rates go up and still low. I have to remind everyone and myself, still low by historical standards. We're not looking at the 70s and the 80s, really, really low. Chairman Powell and the Federal Reserve had said that they are going to raise rates, and so we've seen these rates creep up. Any thoughts about the impact of what Chairman Powell could do as a result of this invasion, what it means to global markets, the U.S. market, et cetera?
Yeah, it's interesting. They have forecast a bunch of small hikes throughout the year. Looks like that is still going to be the plan, but it could change at any moment. These will be incremental, but already mortgage rates have been getting higher, flirting with that 4% mark. So it is having an impact on some consumers. Really doesn't. We're seeing everyone who's already wanted to refinance has likely done so. And so really it's going to be a question of purchasing power for people wanting to get into the market. But one thing that's interesting is the number of the amount of homeownership in the U.S. is now over 65%. So despite the fact that the housing price has been so high, people really want to own homes. And so I'm not seeing that a slight uptick in mortgage rates will really impact people in terms of staying out of the housing market.
Well, Deidre, they want their home, their dog, their 2-car garage, the 2 cars, and the picket fence. I mean, that is really the American dream, or at least it It was. I mean, I know there's this, in all seriousness though, and going back to the Federal Reserve, I know that there's this balancing act where, you don't want to choke off economic growth, especially with what's going on globally. And the sanctions and the war has an impact on so many different pieces of our life. I mean, gas prices, real estate prices, consumer goods, all these things are kind of, so it'll be, I think it's going to be very interesting to see what the Federal Reserve does in light of these new challenges.
Absolutely. I think one of the things that's interesting about this inflationary cycle is that it's very bifurcated. Energy prices, as you mentioned, so high, but inflation isn't equally distributed. So it's a challenge for the Fed to use interest rates, which is sort of a blunt tool when there are so many different factors impacting the economy.
Yeah, well, again, it's great to check in with you. It's great to learn more. I feel like we have to continue these types of conversations. People need to be active. If you're thinking about buying a home, look at the rates, look at the home, and think about whether or not you want to waive those contingencies. You might want to think twice if you are leaning towards that way. Deidre, great to talk to you as always. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Thank you so much.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of the Morning Pulse. Want to see our latest content? Search our archives? Well, check out our website. That's www.broadcastretirementnetwork.com. It should be right about here. And our streaming partners like Samsung, RAM, Roku, Amazon, and over 100 more. We're back again tomorrow. We'll be taking a look back on BRN Weekly at some of our best segments this week. You're not going to want to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.